Good morning, everyone. Thank you for inviting me here today. I apologize for my English, that I'm speaking English, but I hope you all can understand either directly or through a translator, and forgive me that I don't speak Turkish. My discussion this morning is on the state of the metallics industry. Metallics being scrap, DRI, merchant pig iron. Let me start with a couple of opening comments. That the sharp and largely sustainable decline in raw material prices in the last 3 years, including a major and further step down during the entire course of this year, is welcome news indeed for the steel industry. However, as most of you here in this meeting are painfully aware, these declines have thus far been almost twice as beneficial to integrated steelmakers using iron ore and coal as they have been to electric arc steelmakers, which are more than 3/4 of the Turkish crude steel production base. And in fact, EAF steelmakers, not only here in Turkey but around the world, have lost or have a competitive disadvantage in the last 3 years of $142 per ton just in raw materials, including an estimated $63 per ton decline this year alone. Our contention is that these price declines will ultimately pan out into a more balanced picture for all steelmakers. But the question is, will we have more pain in the short run for those of you who are using mainly scrap, DRI, or merchant pig iron? First, let me show you this. This is what I'll call the profit pool in the steel sector. And this means if you take all the profits in the steel industry, the iron ore industry, and the metallurgical coal industry, we can see how this has moved every 2 years, 2009, 2011, 13, and 15. Now, two things I'll point out on the slide is this profit pool, and it's based on EBITDA, a standard profit financial measure, is obviously declining, primarily because the drop in profits by iron ore and coal companies. But also what's happening, if you see in the red, is that the steel sector, which has been 25, 24, 32% of that pool, is now, we think, next year going to take 2/3 of the entire steel and steel raw material profit pool, albeit that pool next year will be just about as low as it's been in 2013 and 2009 on average. And here's the problem. You've seen this. I won't belabor this issue, but we've seen since the start of this year the price of iron ore declined 50%. As of this morning, iron ore 62%. China CFR is now again below $70 a ton. That represents a 50% decline. Whereas if we take the U.S., for lack of any other measure, I could take a European measure, whatever, busheling, the high quality scrap, is down by 21%. And these numbers are changing. Just in the last 2 days, the price in the U.S. and European market for scrap has fallen another $10 to $12 per ton. So we're in a very volatile period. And the bottom line question I think we all want to try to be comfortable with is, where will it all pan out? How will it come out? The scrap users are at a clear disadvantage at the moment. And on top of that, we're seeing very sharp differences in the price of scrap from different sources, the percent change. And here I've chosen two, the CIS, three different measures of their scrap versus the US. And you can see a fairly big difference in the relative change. What that refers to is just the differences in the relative strength of those economies and also the direction of their exchange rate movements, which is why I took these two countries, because their exchange rates and the relative economic health are very sharply moving in different directions. And we saw this earlier. This is the ratio of scrap price to iron ore price. And we can see periods prior to 2005. To be honest, we think that's largely irrelevant. We're in a totally different world now. So the big thing is looking from 2005 forward. And we can see that scrap has been relatively more competitive than iron ore for most of this modern era since 2005, although that ratio has now gone up by 100% in the last essentially 1 year. And you saw this earlier in some of the slides that were presented before. So in other words, the higher this goes, the less competitive your electric arc steel makers are with traditional integrated steel makers. And here's a picture of the worsening competitive stance of electric arc scrap-using steel makers compared to integrateds. And we've put integrateds in two forms. Those who have captive raw materials, because they're actually losing competitive ground just as much or more than electric arc steel makers. So I'm going back all the way to 2009, which was more of a normal year, although it was a very stressful recession year. It's unfair to compare our situation with 2011, although we put that in here to show you that 2011 represented an all-time record level for both iron ore and coal prices. So that was where electric arc furnace steelmakers were most competitive. But really, when we're looking at this, what would be a more balanced way is to view where you were if you're an electric arc steelmaker competitively in 2009 versus today. And you can see the movement of the electric arc, the integrated steelmakers with and without. And you were all painfully aware of the situation with electric arc steelmakers. What a lot of people don't consider is the fact that integrated steelmakers with captive raw materials, like the Russians and so forth, their cost to produce iron ore hasn't changed in a number of years. It's stayed pretty much flat because it's their cost. So they've lost ground. And again, the sector that has done the best is the integrateds without their own raw materials. Now here's our view of the 10-year outlook for electric arc and integrated steelmaking capacity growth. And I'd suppose two things here are worth pointing out. One is that despite the present significant competitive disadvantage for electric arc steelmakers, we do see their capacity increasing continuously throughout the next 10-year period and frankly beyond that. And also we see a moderate reversal in the downtrend in electric arc furnace share of world crude steel production, moving up to about 31. And a big part of that assumption for us is what's going to happen in China. And here's our capacity bridge for electric arc steelmakers. We think, as I mentioned before in the previous slide, we see production going up by about 180 million tons for electric arc steelmakers, and capacity going up 100, the difference being a higher utilization rate perceived for existing electric arc capacity. Now, importantly within this is that there will continue to be, and we think, a heightened level of alternative iron capacity being built over the next 10 years. We think DRI capacity, for example, will almost double by 2030. And that is a very good thing for electric arc steelmakers here in Turkey, as that will relieve pricing pressures in the scrap market. Now, I'll take a quick look at Turkey, with Turkey, Italy, and the EU. Just 3 quick slides at DRI and MPI imports. And we can see on the left chart the trend for this. Turkey imports significantly more merchant pig iron than DRI, and it's getting its materials of those from the countries you would expect: Ukraine and Russia, primarily in merchant pig iron, and then Russia and Venezuela on the DRI side. Now, here's a development that has just been announced within the last week almost, and that is the possibility that Italy could be building 2 DRI plants, one in Algeria and one in Piombino, the site of the former Lucchini or the Lucchini plant. I'm not so sure. I mean, both of these would be 2.5 million tons of capacity. It doesn't seem that the Piombino site would have an advantage in any area, a cost advantage in terms of iron ore or natural gas. So it's very difficult to see how that would come about. But that's what it would look like if we had one of those operations. And we think one of them probably will come into fruition, as well as a Scandinavian 1.5 million ton unit is very likely to be built. And then finally on this quick little section is here's a picture of the EU 27 and their imports of DRI and MPI. Again, you see the same sort of a profile of more use, almost 2 to 1, of merchant pig iron versus DRI. And you can see who's importing on the right within the EU 27. We see by far, as you would expect, Italy and Spain on the DRI side. And again, that has to do with their electric arc furnace production levels relative to the other countries within the EU 27. Now, let me take a quick look at the United States situation, and I'll just give you a couple of quick slides here, and that is the U.S. is the world's largest scrap exporter. It's one of the largest scrap consumers, and one of the largest sellers of scrap to Turkey. So I think it's an important for you to understand some of the big changes that are going on in the U.S. metallics market and how that may impact steel producers in Turkey. So here are 2 charts. The one on the left is U.S. alternative iron production forecast through 2025, just 10 years from now. You can see the dramatic change that's occurring. And on the right are imports of those. And it's startling to many to see that we're projecting imports will start declining towards the latter end of the decade, but nonetheless remain fairly high despite all of this new capacity. Here's a picture of U.S. 15-year history of crude steel production by EAF and BOF. And as a result of these new DRI plants, and actually there'll be new merchant pig iron facilities by one or more major electric arc steel makers with partners coming on as well. It's not all DRI. But based on our projections, we see DRI and MPI producers accounting from less than 3% of all iron ore demand in the first 15 years of this century to accounting for 1/3 of all the iron ore consumed in the United States. That's a major change. And then alternative iron consumption, that pattern will fit what I just described. And more importantly, and this gets at what I think many of you are asking, is how high can alternative iron consumption actually be in practice? We think as a result of all of this, the sustained imports and the sharply increased production, that U.S. electric arc steelmakers will be consuming alternative irons at a rate of 30% of their furnace charge. And in fact, they can technically use 40% on any heat in DRI. Soon that will be 50, and we think within the next 10 years they'll be able to technically melt with as much as 60% DRI. At least Nucor will be able to do that. And I know a number of you are considering vertical integration, and that means backward into alternative irons and so forth. But be careful what you wish for sometimes. I mean, there's no rhyme or reason for this necessarily, but let's take two of the U.S., the big electric arc steel makers, Nucor and Steel Dynamics. On the far left, you see how their profit margin, this is their EBITDA margin, would look if they were just purely nothing else but a flat-rolled only producer. They would have margins up to 20%. That's profit margins. Now, in the middle slide, we add back in long products, bars, structural steel, wire rod, etc. That dilutes their earnings. So their average 7-year profit margins go. And then finally, and this is what I was getting at when I opened up the slide, is when you add in raw materials, that's DRI plants, MPI plants that are owned by these companies, and their downstream processing, like decking, siding, pre-painting, etc., their margins are cut more than 50%. So that's something to think about and to really understand before you get into owning and operating your own DRI or MPI plant. And now, finally, my final section is on scrap, which is what my main focus here. And I'll look at this in 3 quick ways. The consumers of scrap around the world, what that means to you, the exporters, and then finally the importers, which includes and actually features as the leader, Turkey. Here is the picture of the world's top scrap consumers last year. And by the way, we have the BIR lists Chinese scrap consumption at about 83 million tons last year. So you're probably saying, why has Metal Strategies put their estimate of actual scrap consumption at 149 million? Well, if you do the math, at 800 million tons of crude steel, 10% electric arc, you would, in order to get as low as the BIR has at 83 million, you would have to have scrap or EAF companies charging 50% of their charge materials as DRI or MPI, which is not the case. And you would have to have BOF integrated steelmakers only charging 6% scrap into their BOF furnaces, which is not. They're charging between 11 and 13%. So that's the reason why we've moderated, and only that one, by the way. The others are as reported by BIR. In EU, and we use this because it's so close here to Turkey, we can see their sharp decline in scrap consumption since the peak of 2007. Not surprisingly, because of the EAF share, especially in Italy. Italy is the biggest consumer of scrap in the EU 27, is a good barometer to compare against Turkey. Germany, with a lot of electric arc capacity, is number 2. All of the others fall a far distant 3rd through 10th in terms of the ranking. And again, looking at the 2 European or quasi-European major consumers of scrap, we can see a totally different trend. Despite some of the difficulties in the Turkish market in the last 2 or 3 years, that Turkey has steadily surpassed Italy in terms of its scrap consumption. And now the second of the 3 aspects, and that is the scrap exporting. And here's 2003, the world's top scrap exporters. And we can see, as you would expect, the United States at 18.5, EU at 16.8, Japan, etc. So that's the picture there. And I want to compare just right now the EU change versus the United States change and what's going on with that. So here's a trend on the left side of the EU 15-year scrap export pattern. You can see it's come down fairly significantly in the last 3 years, and that trend has continued for 2014 as well. When those numbers finally come in, you'll see those down. Very interestingly, Europe is very dependent on Turkey. Over half of its exports of scrap go to Turkey, and no other country in the world accounts for more than 1.6 million tons out of their 16 million. So it's very interesting, the dependence between Turkey as the buyer and the EU as the seller. Now here's the same look at the United States, which is Turkey's normally second largest source of scrap. And the United States has seen a much larger decline in the scrap. You can see it peaked at 27 million tons in 2011, and is now, we project, will be about 16 million this year. And what I've done on the right is shown you why that change has happened. And you can see the big player that caused most of that is China, declining sharply. You all in Turkey have declined your orders from the United States as well. So that's the reason that the EU has fared better than the United States in maintaining its scrap exports. And now finally, my final comments rest on the world scrap import market. We can see for 2013, Turkey was by far the largest scrap importer in the world. No other country was even half your size in terms of scrap imports. And I'm just going to give you 2 quick slides of all of the major 8 countries that import scrap around the world. Our contention is that most of these countries over the next 10 years are going to be increasingly self-sufficient, and that includes Turkey in their patterns. And take a look at Turkey, relatively flat. the last few years. South Korea is going up, but at a moderating rate, indicating that they're getting increasingly self-sufficient. China is going down sharply, and we think they could well be an exporter within the next 10 years. India down sharply. India is not a country that is going to be relying on scrap imports for its metallics. Taiwan down. EU, which is a major importer as well, third country imports, down sharply. And the United States, typically the 5th largest scrap importer in the world, in addition to being the largest exporter, has had a very flat pattern since 2004. If we look at the 15-year trend for Turkey, we can see the volumes peaked in 2012 and have since come down moderately due to the difficulties we've heard at this conference with other speakers, the challenges in the MENA market, export competition from China, difficulties in the home market here in Turkey, and the scrap import sources of Turkey, primarily EU 27. For the next 10 years to 60 to 65, which will be a very good thing, only if nothing else, because your costs will go down, all of the things being equal, because of the lower freight rates. And now I'm going to end with just 2 slides. So thank you for your attention here. Here's China's scrap consumption pattern, including a forecast through 2025. And it's very difficult to predict what will happen with China. I think from a Turkish standpoint, your most ideal situation would be as low as possible electric arc furnace production out of China. No change in the furnace charge mix in both electric arc and BOF steelmakers in China. And therefore, that would result in a significant level of export volume going into the market and essentially a zeroing out of imports. So what that would do would be to take tremendous pressure long-term off scrap pricing. And here's what we see for Chinese supply, 2014, 2025, and 2025 high in terms of what capacity will or what requirements for scrap will be under these 2 low and high scenario. And the scrap supply on the right, by the way, is what it will be. It's already has been determined. It's not a matter of what will the Chinese build? Will they build more electric arcs? Will their production slow down? This supply was determined over the last 10 to 30 years. So it's going to come no matter what. But the thing that will be determining the whole equation and how difficult or beneficial the scrap market pricing environment will depend on the left chart, which is how much demand. And I'm ending my comments with this rather busy slide. I apologize, but what we're looking at here, and let me just walk you through. This is my last slide, so thank you for paying attention. Here in 2024, you can see their estimated crude steel production for China. The share of that crude steel production, electric arc and BOF, and the scrap charge percent. We're saying 90% for electric arc, 11% for basic oxygen, results in a scrap requirement of this. Now, moving on to 2025, what we've got is crude steel production at 1.05 billion. and we maintain the same ratios. So if we were to do that, the same scrap charge rates and so forth, you'd have about almost 200 million tons of scrap demand in China. So that's about 50 million more than you have now. And then finally, in a higher growth where we've got China up to 1.2 billion, probably unlikely that will happen, and where the EAF share increases from 10 to 11, and therefore the BOF share drops from 90 to 98, and the charge rates for electric arc remain the same, but for BOF just going up 2.5 percentage points, you can see the result of that. You would have, between the combination of 150 million more crude steel tons and the slight increase in BOF scrap charge rates, you would have 63 million more tons of scrap. So all of these things go into determining what picture you're likely to face over the next 5 to 10 years. To be honest, we think you're going to, at least medium and long term, regain most of your competitiveness vis-a-vis raw materials over the next 5 to 10 years. The question is, in this very early short-term 1 or 2 year period where iron ore is falling fast and many scrap peddlers are not willing to sell, they will hoard their scrap rather than sell it, waiting for the higher prices. That suggests to us that you may be in an environment of competitive raw material cost disadvantage for the next maybe 12 to 18 months. But you can see that disadvantage is moderating each week that goes by. So with that, I thank you for your attention, and I turn the meeting back over.
Okay, please. Thank you very much.